everyone. Turnaround Tuesday. How's everyone doing? Hi, Brock. Thank you. I'm doing fine. I've been cocooned for a few weeks now. Glenn, how are you? Hope everyone else out there is handling all the magnitude 9.0 market moves. So, what can you say about the dollar? Almost at new recovery highs. Sure looks like it wants them. One caveat with the yen right here is it's not as strong as the dollar was. Look at the dollar candle. See, compared to the yen. So if you want to fade dollar strength, I would do it with the yen rather than, the Dixie itself. Okay, so I also wanted to talk about the S&Ps when it's a victory when they're unchanged here. Be careful with your shorts now, especially if we get a new low. There you go. Potential 3 drive at new lows down here. Looks like 2320-ish. Not up there. Not up there. What the heck? All right, anyway, it's kind of like this. Kind of like that. All right, so we'll see what's happening there. Again, the commodity currencies are under a lot of pressure. I'd be careful with Kiwi down here. It's a turnaround Tuesday shot, diverging here. I mean, there's, it's really catching a falling knife, but I'll give it a shot because there's a little bit of divergence here. The metals, silver's trying to hold in the gold, yesterday's lows. Actually, what you have, and I would wait, are an inside day. So maybe an inside day followed by an outside day tomorrow where we take out today's range. So on an inside day, I just leave the market alone and then see which way it comes out of the inside day the next day, and then look for a potential outside day. So maybe that's setting up for tomorrow. I'll be watching it, not because I'm bullish the metals at all, but I can make a case that if we start to hold here, this 1450 holds, why can't we get a rally back to 1590, 1600? We've come down $250, right? So why can't we rally 61.8 and then fail again? So those are a few things that I'm watching right here. Taking a shot at some bottom picking in Aussie and Kiwi, and we'll see if they run over me today. I'll let Blake, that's Blake's specialty, Sean, cover the USD Mexican, and maybe he's around right now, wants to address it. I do want to remind everyone that I think the key word was a few weeks ago, hey, Blake, USD MEX has a heartbeat. And Blake showed you at the bottom in that wedge that was a great way to play risk off, and it was. How you doing, bro?
I'm okay.
Yeah, it's Twilight Zone.
Yeah, I got a little run over. Getting a little run over actually in the. I got it in the Aussie overnight. I tried to pick up the Aussie on the cheap.
Yeah.
What screen do you see right now?
I've got your Dixie up there now.
Okay, so I was trying to play the Aussie off of this 78% retracement, 618. 261% extension, and I'm like, okay, well, with the equity markets were bouncing last night, I put in a bid, I got hit and triggered and stopped. So it's like, wow, and then, I tried to sell some dollar Canadian as we're up against this really big resistance, and then, boom, it's just going through, all of my levels. This dollar demand is
Yeah.
insatiable today.
Yeah.
It is absolutely insatiable. So you got to be really, really, really careful trading small positions if you're gonna, you know, be fooling around here. I mean, I'm trying, but it's like, man, I mean, you look at the dollar Mexican peso, we are screaming higher.
See that wedge down there, Blake? That's where I said, hey, Blake,
Yep.
we've got a heartbeat down there.
Oh no,
Yeah.
that was like the perfect,
Yeah.
it came out of that wedge. Obviously, I mean, I played it to the long side down here, but who was expecting?
Who could hold something like that for up
No,
to
I
here?
mean, it was,
I mean,
but
some people, I say, some of these runaway trades, maybe you're better at it than me, Blake, but it's almost like you have to either be naive or greedy to still be long the Mexican peso from 3 weeks ago.
well,
Don't you think?
as a trader, it's really difficult to do, that type of trade. But
Maybe that's trailing stops keeps you in there, instead of discretionary. Maybe I'm thinking about it that
yeah,
better at putting the position on than holding the position. Maybe if I had something mechanical to keep me in instead of my own judgment, I'd be there for more of these windfalls.
yeah. I mean, being able to ride that out on the long side it would be very difficult to do.
So hard.
But mostly the greed will get a hold of you because you would be like, man, okay, I'm up a huge amount, at this level. I'm going to go ahead and take some profits because it looks like it's turning. Um, but I want to say that these moves are big. I mean, look at the euro dollar. We sliced through the
Yeah.
200-day moving average. We pushed through 110. We're trying to stabilize down here, but man, I don't know until you start to see some of these commodity currencies turn, like the Aussie. I'm looking at it right now. If we can, bounce back above 61 cents. Now, you're probably thinking, wow, 61 cents, that's 100 pips from where we're at.
Yeah.
Yeah, that's basically what I need to see in order for us to, for me to feel confident, like, oh, the Aussie is trying to turn a corner here. The Aussie has been beat up. I mean, we're below 60 cents right now. We've lost a 60, and these are levels that we have not seen since the great financial crisis.
Yeah.
Right.
Yeah.
I mean, if you look at a month or monthly basis, we hit lows around here back in October of 2008, and we didn't quite hit 60 cents. I mean, we're below that now, which it's pretty scary if you think about it, because you think about what's this market pricing in, to have moves like this happen. It's pretty massive. So, some of the other trades you may think about, like, one of the currencies I'm trying to play right now is I'm trying to play the Euro Aussie on the short side. Because we're in this wedge, trying to play like maybe a cross rate might be the better option for some of you guys. I was talking to one of the guys from the office about, the euro sterling. It's like, yeah, you can bypass a lot of the volatility that you see in these dollar pairs by trying to trade, a cross rate versus
Great idea.
yeah, well, I mean, it's like,
instead of just, the magnitude, we wanted volatility. I didn't want this much.
yeah, careful what you wish
You,
for,
you know
right?
what I mean, bro? I wanted
Yeah,
expanded ranges, but
Oh, come
not
on.
this
Stop being
much.
ungrateful. I mean,
Huh?
if we have to compare the prior situation that nothing was moving, you could literally
Okay.
be away from your screen for 10 hours, come back and not even realize it hadn't been 5 minutes. I'd
yeah.
rather have
Well,
this.
for senior citizens, that's, that was.
For senior citizens. Yeah. Anyway,
We're
but
moving
yeah,
too
I mean,
fast.
the Aussie dollar is down 2% as we slice through some major levels of support, and frankly, I just don't know where it's going. I mean, I understand that we have a big slowdown globally, and but it's like, where's the bottom in the Aussie? I don't know where it's at. Frankly, I don't know. But Steve, I unfortunately I have to tend to the markets right now. Do you mind taking over here?
I'm here too.
Okay. Do you guys
mate.
mind?
Yeah.
Okay.
Actually,
Thanks, guys.
Thank you, Blake.
Hey, good luck today. Sorry, I gotta attend to this stuff.
Sure.
You do, mate.
Actually, speaking of the Aussie, I know everybody hates it and it's at ridiculous levels, but the way I look at it and the way I try to look a little bit further in the future, I'm not a scalper, I'm not a day trader, I'm not even a swing trader. Look at what's Australia most dependent on, and it's China and commodities. China has, at least from what they tell us, seemed to have turned the corner with the virus. Granted, they use some pretty military style methods to contain it, but
the least to say, yeah.
yeah, it seems to be working, if we believe what they tell us. And you have other countries like South Korea or Singapore and Hong Kong. They were one of the first countries to actually have cases, and everybody listened to what they had to be done. They followed everything, and look where they are. They've had very, very little damage. So my point about the Aussie is heavily dependent on China and commodities. And if China is the first major economy to turn the corner on this, obviously the global economy is going to have some trouble. But if China is the first to turn the corner, then I think the Aussie would be one of the prime candidates to be long against the dollar, but not yet. I was discussing this in chat room with some other friends as well. We're seeing exactly pretty much what we were seeing in 2008. And the dollar is the short-term safe haven currency. Whenever the proverbial crap hits the fan, everybody goes to buy dollars and treasuries and things that we know for decades and decades that are safe. So
Indeed.
This is exactly what's happened. The dollar has been bid and will probably continue to be bid.
Yeah,
because
my opinion about the dollar, but I had said in advance that I wouldn't be surprised if initially the market's response would be to run to the dollar. Plus, it makes sense for an extra reason. When many of the investors are calling in and saying, "Get me back to cash." Cash means dollars, right?
Yes. And we saw that. I remember when I was market making 2008, and I remember the crisis very well. From say August 08 until early 09, like February, March, everybody just wanted dollars. End of story. Myself included, everybody. So we will see this. The crisis is what? This crisis is what, a month old? Maybe on the second month. I think we have a little bit further to go. I think equities are still in sell the rally mode. And as long as this happens, the dollar will be strong. Now, things will reverse. For equities to actually recover, the dollar has to weaken. And this is exactly what we saw in 2008. And, I had another conversation about metals with Paulie on the chat room, and I've had it with other people. And they're saying, sell gold. Short term, yes, I think we might even get to the breakout point, which was what, 1300 or 1300 and something, whatever it was. But and this is because I've seen this with a friend of mine. They're long equities, and they're they have to meet margin calls. They have to do something, and they you know how equities can move. You can be up 100% in 2 months. When things start going well.
That's why we call them paper profits, Stelio, because many people don't realize that paper profit is not a profit.
Yes.
It will become a profit once you cash out.
Yes.
And some people don't understand the difference, because they're like, okay, I have paper profits. I can just send in an order, and those profits get realized immediately. But what many people don't take into account is that bear markets tend to look like this, and very frequently, until people make the decision to actually cash out, they can find themselves 40% away from the highs, because they don't react the first day, they don't react the second day, they're at minus 10%. So now they tell themselves, okay, I'm going to wait for a bounce to be at minus 5% from the highs, and I'm going to cash out then. And then it goes to minus 15%, and they're going to be like, okay, I'm going to wait for a bounce, and I'm going to cash at minus 10%.
How did you get your hands on my trading journal? I had it locked up. I was too embarrassed.
Seriously, though, you have people who have been long stocks and are now down 30%, or even on a particular single name stocks, you could be down more, 40, 50%. And what they're doing, I know a couple of cases. saying, what am I doing? Well, in my portfolio, I also have gold. What's gold done? It's only down 12% from the peak. Okay, I'm going to sell that, which is still relatively okay, and I'm going to fund the other position. That's what's happening now. It was happening in 2008. It can happen for a while. It will not reverse from one day to the next. Even if equities have another plus 10% day like the other day, this is not going to reverse. You know, people are still trying to get out, and that's what I've been trying to say in the chat room on this webinar for days now. This is, you know, this is not over, because people, first of all, retail investors are still trying to buy the dip, and there's a big chunk of people who are waiting for a rally to get out, and that's what we saw today.
Unfortunately, there are also a lot of managers advocating to people that this is not where you should be selling. I mean, you know, we're already in a bear market.
Yeah.
That's it. I mean, we should be very, very close to the bottom. You don't want to be the idiot that sold at minus 30%, and then within 2 months we're going to be at new highs. There are actually people, I'm watching them on Twitter, that are advocating that BS, and unfortunately, they obviously have some clients that buy into that. I have no words about that, but it is what it is.
Stell must have also been at my webinar where I teach sell your winning positions to fund your losing positions. Stell, you too saw my journal?
Yeah. So,
yeah. Well, look, you know what? I mean, we can talk about this. I've done all of that.
No,
Who hasn't tried? Who hasn't done that? Yeah. So, you know, our role is we've already stepped on these landmines and had serious injury, financial injury from doing it. So if we could help you avoid that psychology and landmine, we're saving you a whole lot of aggravation.
Yes.
I totally agree with you. First of all, we've all done these mistakes, but you know, the question is, let me say it using ancient Greeks were, you know, ahead of their time. Unfortunately, the same doesn't apply with modern Greeks, but whatever. So they had two sayings that I can refer to that. First was to this examartin oukan drosophu, which meant that if you do the same mistake again, you're obviously not very wise. And the second thing they were saying is that that, you know, let me make it simple actually. Smart people, stupid people learn from their mistakes. Smart people also learn from others people's mistakes.
Yeah, good one.
Yeah.
And the third thing we used to say is don't eat yellow snow. Yeah. No, absolutely. And history always repeats itself. It's crazy. You know, I've been going back to 2008 almost daily for the past weeks, and you see the same kind of situations, the same kind of reactions. And anyway, you know, what can we do? We can.
History keeps repeating itself because people have short memories and unfortunately don't study history that much. In my opinion, one of the biggest mistakes of the educational system, more or less globally, is that it doesn't focus more on history. And when I say history, I mean on the interesting aspects of history. It's not like, you know, teaching children, you know, when X thing was signed or Y thing. I mean, teach them, you know, general stuff of history, which are very indicative of human passions, human mistakes, human errors, you know, because these are the important ones to know, like what led to the biggest mistakes we've had in mankind, to make sure that, you know, we minimize the chances of repeating them again and again.
Yeah. Yes, absolutely.
Okay, Stelio, what else did we have? We live in interesting days for sure. So what else did we have that might be of interest?
Well, data-wise, I don't think anything is that interesting anymore. We had some numbers out of UK, but this is for January. So average earnings index came in at 3.1% versus 3% expected.
That doesn't really matter. Let's see February's data, because that's where it's going to start getting, you know, interesting.
But we did have German ZEW economic sentiment for March. expected, well, from 8.7 expected minus
Drilling
26.
for oil,
Yeah,
minus
I can remember the
49 and a
minus
half.
49. Yeah, yeah.
Yeah.
So that's, I think this is all details. The question is, what's going to happen in terms of fiscal stimulus in, well, France? They promised something like 300 billion euros of loans to be guaranteed, or something like that. So, you know, they're bringing the big guns. Are there any bigger guns? I don't know. But they're trying on both sides. Short selling bans are starting to get implemented all around the globe. My personal opinion on those is they work for a day or two, and then people realize that if you're banning short selling, you are, you know, you're kind of panicking, because
in my opinion, short selling bans should be banned. Any
agree.
type of market regulation should be banned, because the only thing you will achieve is distorting the natural function of the market. For example, it's completely unfair because we've seen many times in the past that, let's say you go ahead and ban specific stocks, the first thing that investors that actually want to have exposure to that will do is try to find correlated, not banned financial assets and short those. So in essence, you know, you end up punishing, for example, other companies because, you know, somebody that actually wants to, you know, sell something short, they have alternatives, right?
Yes. Yes. So, you know, short selling, I don't think works. And, you know, at the end of the day, even if you ban short selling, you're still going to be left with a market that wants to resolve lower, in my opinion.
Yeah.
So
Plus
yeah.
one more thing, if you ban short selling, don't you also, under such a stress, limit the ability of somebody to buy the market? I mean, I know that you can hedge, theoretically speaking. There's no question about it. But you know, when you are in an environment that they've started banning your ability to do stuff, personally, Stelio, I would be a lot more hesitant to be long the market in any capacity. You know what I mean?
Yeah. Yeah. No, I agree. I agree. And these are all measures which are driven by, you know, by fear, I would say. So as long as this situation persists, I wouldn't be one. Obviously, you can make money being long the markets here, but I think the general direction is still lower. And I've said this in the chat room, you know, from this morning when futures were up 5%. I said, look, I think this is a selling opportunity. There's no reason for the market to be up 5% in Asia, other than the fact that it was down 12% yesterday. So, you know, in my opinion, nothing has changed. Obviously, there's going to be short-term moves, but until something changes dramatically, I don't know what that's going to be. We're still in sell the rally mode, and I've said this before. I think the bottom in these markets is still not close. I don't think we're going to drop 70% like we did in 2008, but I think you know, the S&P is at what, 2450 now.
Let me say, Stelio, that I wouldn't find it impossible as well, though. I mean, if you
No,
tell me
nothing's
if it's impossible to go minus 70%, given the fact, you know, I also believe that the markets would tank sooner rather than later at the next economic slowdown, which was obviously coming. I mean, the bond market had already sent all the signals that a recession was coming, and the only reason we had managed to stall it a little bit is because they were doing everything they could, you know, to make it until the next November and the elections. But unfortunately, now that the market found a very serious reason to sell off, it wasn't just, you know, a temporary cause. Unfortunately, coronavirus proved to be a very, very important disruption in the function of the global economy. I think that the combination of being in a bubble, which we were, with actually getting a very serious reason to violently prick the bubble, you know, doesn't make it impossible to see levels, you know, I don't know,
Yeah. It's not
1800.
impossible, but I don't. Yeah, I've been saying. I know it's wide, but I've been saying. I think the bottom is 1800 to 2200,
Yeah,
somewhere
that's
there.
77.
But
That's 47% lower. I think we can easily get there, and you know, if we go below that, because look at the importance of 1800, right?
Yeah, yeah, it's big.
I mean, it's a huge level. If we penetrate through that, then a continuation towards 1500 doesn't seem that unlikely to me.
Yeah. Our friend here writes a coronavirus vaccine would calm markets. I think that the markets at the moment are actually discounting the fact that the vaccine is going to be found. I mean, we get all the signals from the US, Israel, wherever it is. There are scientists who are working on it, and I'm sure it's going to be found. But the question is, it's going to be found and it's going to be tested and all that after a while. You know, it takes months, so it's going to be effectively ready for the next season, not this season. So the question is, what damage will the global environment and the global market get from this total, you know, breakdown of everything? You know, I'm stuck in my house. Everybody is. You know, nobody's doing anything. Nobody's buying. You know, moving their cars, or very few people are.
As long as I'm alive, Stelio, with the exception of a short period of time around the Chernobyl incident for countries that were adjacent to it. We weren't really adjacent, but as you remember, even Greece, you know, people were very much afraid. You know, they weren't exactly sure.
I was living in Paris at the time, but
okay, you were in Paris back then. I was actually in Greece. So, with the exception of that event, which only affected a limited number of countries that were, you know, in some distance to Ukraine, and for a limited period of time, there is nothing even close to what we've been going through with the economy literally, you know, stopping. I mean, everything has halted, right? I mean, people are not consuming, besides the, you know, the basics. Go ahead, Coach.
Oh, I'm just saying that people should, you know, give themselves a break if they're having a little bit of a hard time. But, you know, I mean, I'm having a little bit of a hard time because of the magnitude. You know why? Unless you're 130 years old, no one's ever traded a pandemic.
Yeah, that's very true.
Unless you're 130. Because you had to be, I figure, at least, you know, 18 years old to trade in 1918.
Not if you were Jesse Livermore, he started trading at 14, but yeah, close enough.
Yeah, so, you know, anyone 130 in here? So be patient with yourself like you are with the market. We've never seen this before.
Yeah,
in our
and
lifetimes.
even if you could trade back then, it wouldn't still be exactly the same, because globalization was not a thing back then, right? I mean, many countries
you had a ticker tape
very
under glass.
Yes.
You know, and you charted by hand.
So it's, you know, I think it's a, you know, it's an incident that we haven't had experience with at all. I'm sure that people in the future will be able to use this experience at some point when, you know, there is another pandemic. I mean, it can happen like once, twice per century, 3 times per century. It's definitely not something frequent, but it's nothing we've seen in the recent global environment, with markets, you know, being so much correlated, and the economy being so intertwined, and, you know, each country affecting what happens to the rest of the countries. You know, also due to technology, a pandemic is much easier, a disease is much easier to become a pandemic today than it used to be in the past, because 100 years ago, you know, traveling traveling from one country to another when they were in some distance meant, you know, either spending days and days on the road or days and days in the middle of the ocean. Nowadays, you know, worst case scenario, in 12 hours, you can be at the other side of the planet. So it's totally different. Anyhow, now, Stelio, if we, by the way, we do have data. So let's first cover the data before we go to the charts. So here is the data we're expecting: retail sales,
and some Canadian numbers as well.
Core retail sales, US retail ex gas, and Canadian manufacturing sales. So what do you think, Stelio? Will these data be affected strongly, or might be of the last batch of data that won't really be affected? I think they might.
I think probably a little bit. Yeah,
Yeah,
they're
me
not
too.
still February. Yeah, so probably maybe flat or maybe small negative.
Oh, actually, they are quite affected. Of course,
Okay, yeah,
I
yeah,
believe next month is going to be much worse.
yes.
Under normal circumstances, especially if we're talking about retail sales, that would have been considered, you know, a very bad number. But I believe that next month we're going to see, you know, a number that's going to be eye-popping.
Yeah.
Anyhow, I don't think the market is really going to react to that, given, you know, what has been happening. I don't think that the market is going to give, you know, that much importance to this bad data, but I think they're just going to become worse as the weeks pass. I think that we've now started seeing the first batch of bad data, and it's going to keep escalating for at least 2 to 3 weeks. So I expect that we might end up seeing, you know, the worst kind of data in a month from now or so, or, you know, even, or perhaps a little bit earlier. Now, let's begin by talking about stocks. First of all, yesterday, at least for the Dow Jones, I think we had the largest point drop in history, not the largest percentage drop. I think it was like having to do with percentage, it was something like the fourth, third, something like that, worse down day. I will focus mostly on the S&P though, because we know it's the global barometer for risk. And I have to say that, you know, despite the horrible day that the market suffered yesterday, completely erasing Friday's appreciation, and despite what was announced at Sunday's open, which, you know, if anybody doesn't know, rates back to zero in the US, and 700 billion of quantitative easing announced and more or less open-ended. So, you know, they threw even the kitchen sink in the fight, and the market didn't care at all. Probably it was more or less panicked because they see that central banks are actually panicking. And, you know, people that have a little bit of brains do realize that this is not a problem you can actually paper over. It's not a problem you can fix with excess liquidity. Yes, with monetary policy, they can help banks remain solvent. But other than that, which of course is, you know, is important, I completely disagree with this type of tactic. Those of you that listen in, you know what my belief is. My belief is that they should finally let the system function properly. They should remove themselves from intervening all the time, because the constant intervention is what makes things worse and worse every time we have a downturn in the economy. But anyhow, this is what they would do. This is what they're doing. So there's no surprise there. Keep in mind, though, that this is a very key area of support that we stopped at. Okay. And the most important reason is because we are currently not only in a horizontal support area, you can see it here on the daily chart, but this is the 61.8% fib from the 2016 low to the all-time high. So, you know very well that 61.8 is probably the most important fib retracement there is, and we know that, you know, very frequently the market responds to it. And, you know, this is the second day so far, very early in the day, of course, the actual market hasn't opened yet, that we're holding here. Now, can we actually rebound from here? Overnight, we did see a decent rebound, and we have retraced most of it. Can we rebound further from here? From a technical perspective, the answer is yes. Fundamentally speaking, nothing has changed since yesterday, but it would make sense in any way after, you know, one of the biggest declines in the history of markets to see some type of a reaction higher. And keep in mind, I've said it multiple times, bear market rallies can be very violent. I mean, you can very easily see a 5-6% up day following a minus 12% day, and that will have changed absolutely nothing in the outlook for the market. So from a risk reward perspective, I would totally understand why somebody might want to take a shot, taking a small position long here against the overnight and yesterday's lows. Having said that, I don't think that the bear market is over. So no matter what happens from here, even if we see a rebound or even if we see somehow at the beginning of a larger rebound, I still believe that you shouldn't lose the focus. And the focus is, this is a bear market and you should be selling rallies. Fundamentally speaking, and the market is now focusing quite a lot on some of the fundamentals. I say some of the fundamentals because it keeps ignoring some other of the fundamentals. For example, are treasuries a safe haven? No, they're not. They shouldn't be under normal circumstances. They are the bonds issued by the biggest debtor on the planet, a debtor which has had multiple presidents in essence openly admit that the whole system is a Ponzi system, because every time they reach the debt ceiling, they threaten that not increasing the debt ceiling means bankruptcy. So how do you call somebody that admits openly that the only way to stay solvent is to be able to borrow more? The answer is insolvent. Because under normal circumstances, you would be able to say, I'm not going to increase the debt ceiling, I'm going to balance my budget. And then your debtors would know that you actually care to repay them back at some point in the future. I think that it's more than obvious that the US, and it's not an exception, right? So it's not the only country. The US is not interested in repaying its creditors back at any given point. There are two alternatives. They're either going to pay them back their money, but their money is going to be worth a lot less, or they're not even going to repay them back their money. There's going to be like a very deep haircut. Given the fact that politicians are extremely dishonest, I doubt that they will have the decency to do the latter. At least, be honest and say, listen, there's no chance we can repay you that kind of money back. So let's sit on a negotiating table and decide what percentage of that debt is repayable, so we can actually restructure. And from that point on, change the dynamics of our balance sheet, so we can actually be okay with repaying our obligations. So I think they're going to go for solution number one, which is inflating the debt away and disintegrating the dollar in the process. Is that going to happen now? No, because now we are in the phase that the market focuses on some of the fundamentals. Fundamental number one being there is a huge supply and demand disruption and the global economy is headed head on to a big recession. They're ignoring other type of fundamentals, that the dollar has absolutely no reason to be a safe haven currency, and the treasuries have absolutely no reason to be safe haven destination for any type of flows. So until the market starts focusing on those fundamentals, the dollar will continue to be bid, and the treasuries will continue to do okay. I'm saying continue to do okay because somebody should be really troubled by the fact that from the 10 years reaching a high, same deal with the 30 years, there it is, we've pulled back despite since then having, in essence, a promise for the biggest bond buying scheme ever happened, that has ever happened on the planet, and still bonds are not actually moving higher. So I do think that the bond market is starting to get fatigued, and soon enough there is nobody going to be left participating in this market, with the exception of like some pension funds and governments and central banks.
The Fed is a bond market now.
Oh yeah, the Fed is the bond market.
You know what's really dangerous is, hi Kitty, that the bonds when they're trading normal, you would have like a 30-second spread between the bid and offer. And last week, there was a full point between the bid and offer.
Yeah, because there is no market anymore.
Yeah,
I mean,
that's never happened before.
This is a broken market. This is
Yeah.
a completely broken market. And I think this is the first sign that things have, we are at the beginning of the end
Yeah,
for the biggest bubble in history, which is the bond bubble. Now, this is something that might take a long time to unravel. Undoubtedly, it might take a long time. But I think that in the future, when historians look back, they will recognize that more or less the end game had begun. Because
by the way,
there is,
Greg in his weekend video was looking for one more high in the
might be the
notes.
case because look at it so far. This looks like a bull flag so far.
Yeah, one more high. Yeah.
So I wouldn't be surprised to see one more high, and then see a big reversal lower in bonds. Here are the treasuries as well. We got a low at 0.36 in the 10-year. We got a low at 0.8 at 30-year. I mean,
I know.
US reported inflation is 3 times what down there the 30-year yield was. Is there a chance that there is any investor on the planet that has an IQ of over 60 that would actually consider buying 30-year paper that would yield 1/3 of reported inflation and have the risk of whatever might happen within the next 30 years? No. So who was buying? Fed and people that were looking to make, a fast buck. So people that were looking for a bigger sucker to sell those bonds at. So bottom line, this has now become probably the biggest example of musical chairs ever played in the financial markets. Because when you're buying bonds that yield, that much less than inflation, with monetary policy cranking up to 1,500%, with whatever that means to future expectations of inflation. One thing is for sure, whoever is buying these bonds, at the end of the day, whoever is holding these bonds at expiration at the end of the day is going to be losing money. So the question is, who are the ones that in between think that they can make some money before they offload them to people that will definitely lose money?
Traders.
Yeah. Yeah,
That's
but don't forget, coach, that at the end of the day, this is a zero-sum game, meaning that in the duration of the bond's life, on average, there will be money lost on it. Some of the people that held them might have made money in between, but for those that have made money, there will be others that will have lost more. You know what I mean?
Yeah.
Because at the end of this bond's life, at expiration, it will have passed from several hands, but on average, money will only have been lost. So capital will only have been destroyed. And, that says everything you need to know to realize that this is a broken market, totally broken market. Now, having to do with the metals, obviously people are focusing strongly on the metals, and they totally understand, why this is happening. A lot of people were caught off guard. They didn't believe that actually metals can move lower, especially given the fact that we had monetary policy exploding. Didn't come as much of a surprise to me because the exact same thing had happened in 2008. The exact same thing had happened in 2008.
Plus silver, Steve, was, it was speaking to us all the way.
Plus we had said a lot of times that gold's momentum had clearly started showing fatigue. Silver was diverging, in more than an obvious way. So am I surprised that we're moving lower? No, I'm not surprised that we're moving lower. Do I think that this is the beginning of a new bear market in in gold and silver, and by bear market, I'm not now using the 20% definition that we use in stocks. I mean, I'm talking about longevity now. Like, is this the beginning of a long period of time that the market can be moving lower? In my opinion, no, it's not. So I'm not
What would
surprised.
change that? What if we took out, you know, that big breakout we had at 1360 in gold where everyone got long? It was like a weekly signal.
This
What
one,
if we negated?
this area here?
Yeah. What
Yeah.
if we negate that breakout?
That's obviously going to be a very bearish technical event. There is no question about it. Given also the fact that to go back to 1360, that would imply that the total move lower will have reached,
78,
as you see, the threshold of a bear market, right?
Okay.
It's 20.5% from the highs. So coincidentally or not, you know, a return to 1360 is going to be entering, you know, officially a bear market in gold. It's going to be a very bearish event. There is no question about it. Will I be selling gold if that happens? No, I will not be selling gold, because there is only one direction I want to be trading gold, and that is higher. Now, I don't have a position in gold, as you know, and the reason is because I was seeing the signs, but I don't want to be shorting gold because I know that under these special circumstances, there might be an event and a day that literally, especially you guys in the US, because you know you are the last market to open during a day, you might wake up and find gold $200 higher. And that can actually happen. It has happened in the past and it can happen again. So I have no problem letting others make money being short gold, and I find nothing wrong with that. I chose to be short palladium, which proved to be a much better trade anyhow, because it yielded me 25% within like a week. But you know, I only want to trade gold in one direction and silver in one direction that is higher. So keep in mind that not having a position is also a position. So currently I choose the latter. I don't have a position, and the next time I'm going to have a position, it's going to be a long position. I totally respect if you want to do something different with it. And in case you want to do something different with it, let me state the obvious. 1445, which was that low, is obvious support, right? And from this point on, 1543 should be considered, this area in general, 1540 to 1550, let's say, should be considered resistance. So if you're looking to sell gold, I think that it would be a good idea to wait for a rebound towards that area and sell there, okay, if you're looking to sell gold. Now, having to do with silver, we covered silver extensively yesterday. I said that $11 is the next downside support, and actually yesterday at the lows we almost made it there because we went all the way to 1120. Next downside support is $11, and we even showed the long-term chart and said that worst case scenario, you can even see a move towards $9, which is a long-term support. So in essence, you might even see silver trading to single digits. Personally, I'm going to be considered that a generational opportunity, and I'm going to be loading the boat. And I have more or less the same outlook for platinum. I actually yesterday bought platinum near the lows, and I made 7.7% of a profit on 1/3 of a position being long. I don't have a position anymore, but I would more than welcome another flash lower for platinum, because I also believe that long term platinum is extremely undervalued where it is currently trading. And in the long term, there is only one direction it can be moving, and that is higher. Of course, nobody says that before it does that, it can go to 500, it can go to 400, right? But if you're asking me where it's going to be at some point, you know, in a few years from now, my answer is going to be, I have a very high conviction that it's going to be much, much higher. Now, let me go through some of you, the rest of your questions. It's not possible. We have finished a long-term corrective move higher in gold and now it's back down to 1,000. Listen, nothing is impossible in the markets, right? Do I believe that it can go to 1,000? I believe it can. Do I believe it's a high probability scenario? No, I believe it's a very, very low probability scenario to go back to 1,000. A very low probability scenario. Okay, so I think it's a very bad bet to believe that gold is going back to 1,000. In my opinion, it's a 10% chance of that happening. And you know, there are much higher chances to see gold trading above 2,000 than seeing gold even approaching the 1,040 lows. And I'm talking about the medium term, because if we're talking about long term, given the distraction of value of fiat currencies, gold has only one way. Gold, and that's not an exception to anything that is tangible, right? Has only one way it can move, and that is higher. Let me go to previous questions. What do you think about Aussie Kiwi long? I think you should be very, very careful. Somebody asked me here, I think it was last week, what do I think about Aussie Kiwi? And just before we had a guest on, I saw this chart. I think it was this day here, because we were just breaking lower from this channel. So I remember saying clearly that, listen, be very careful, because Aussie Kiwi seems to be breaking down from this channel. So I think this is a bearish development and we should be trading at parity rather soon. And guess what? We almost made it at parity. The low was actually at 10016 or something. So, I mean, we have these lows back there. So we are testing more or less the 2015 lows. So if your only criteria is you want to be buying the 2015 lows because it's the 2015 lows and not only the 2015 lows, but if you go back in time, you know, we've had lows at, you know, current levels also in, what was it, 2005, 2004. We just spiked lower at the end of 2005, but that was, you know, a spike. We then almost spiked down to that in 2008. So bottom line, we are now at an area that we haven't traded below in, you know, who knows how many years, if ever, right? I don't really, okay, let's go to the weekly and see if we go really back in time. No, at least here I don't have data before 2001. So at least until 2001, we have never been lower than this level. Okay, so yeah, I mean, this is an argument, right? But personally, from a risk reward perspective, it makes sense. I mean, you buy it here, you put your stop loss below parity, and that's it. But from a technical perspective, other than the fact that these are multi-year lows, I see nothing bullish with the pair, right? So, I mean, you have a very well-defined risk-reward ratio, but in my opinion, you have absolutely no other reason or evidence that that would be a good idea. Now, if we had this conversation, theoretically speaking, let's say tomorrow, and in between we've had like a big daily candlestick that points to a reversal, then we would be able to say, oh, look at this daily reversal at such a key support area going back 20 years. Now, you know, that would make for a much better argument. But so far, the only thing you have is the importance of that level in the past as support. But you know something? Every support can break and every resistance can break, and they eventually do. So I wouldn't be selling here. Okay. Sorry, I wouldn't be buying here. That's my point of view. Trend lines are a great way to stay in. Oh yeah, Ben, I know what you're talking about. Blake was talking about it before. You meant, in essence, using a trend line to stay in a trade that goes vertically, as we saw USD MXN go. That's what you mean. And I agree with you. Trend lines are a good way to manage your risk by trailing your stop loss when a market starts really trending. So, for example, clearly educational now, what Ben means here, let's take the example of USD MXN. So let's assume you traded that after breaking through that wedge. Given the fact that this has been such a strong uptrend, you know, if you drew that trend line and said, you know, that you're going to trail your stop loss accordingly, you would still be in that trade. So yes, I mean, that's a valid point. By the way, keep in mind, the USD MXN has now reached the 261.8% extension of this move lower. It has moved 25% within 18 trading days. I mean, this is a massive move for a currency pair. I mean, it's like having a stock move 70% in that period of time. And the daily RSI is at 92.41. So bottom line, what I'm trying to say here is, I don't know who had the guts to ride this from the breakout to where we are today. But this market is definitely in need of some type of a pullback. Okay, so there is clearly no risk reward anymore to be long here. I think that if you're looking to be long here, the first area you should be watching would be a retracement back to 22. That would be the first area. And after that, 2085 before we see a continuation higher. So, nothing can really move in a straight line. I think that USD MXN has already done, as much as it could do to almost move in a straight line. So you have to start being a little bit careful here. People that were short here have already been destroyed. Probably there is nobody here that has survived being stupid enough to be short to collect 5% carry down there, because they've already lost like 5 years worth of carry and they've probably blown up their accounts. So now that there is probably not many left in the market to have to get rid of their short positions, which in essence, triggers more selling, I think we're due for some type of a pullback. Okay. 2001 low, Aussie USD. Yeah, Aussie USD and Kiwi, I mean, they're unstoppable, really. For the time being, it's just a one-way street. We've sliced through a confluence of supports, and now we have to go back to 2008. We had a spike down there, and before that we have to go back to 2003 to find ourselves in in that level. I remind you that in between, the Aussie found itself trading for a very decent period of time above parity, and soon enough we're going to be at half of that. Okay, Kiwi, more or less the same story here. Next downside support, by the way, for the Kiwi is the 161.8% extension of that last rebound, which points to a move towards 58 cents. As you see now that the Aussie Kiwi is more or less at parity, those two pairs are trading at same levels, right? So, both of them now below 60 cents. Let's see. Blake was here briefly, but he had to jump on the markets. You barely missed him, FX trader. So Blake was here, but he stayed for like 10 minutes. He gave his outlook and then he had to jump on the markets. I remind you that, we're all traders, but Blake specifically trades for Gelos Capital, one of the biggest FX funds. So, you know, he's trading like big money. So obviously that has a priority, right? I mean, we all understand. And I bet that you appreciate more the fact that you have people here with the experience that Blake has, Stelios has. You know, they've traded literally in their careers, they've traded billions of dollars. And, you know, when people that have, you know, such an experience and so much skin in the game give you their opinions, I think that's worth something, right, Coach?
Yeah, it is, definitely. And there's plenty of experience here. And, you know, with Blake not being here as much in face because he's busy is just another reason to join. And
Yeah, because we have to say that Blake is, even under this volatility, and, you know, during these markets, he's all day long on the chat room. And I'm not exaggerating. I mean, he's there at least 12 hours per day. So, you know, you're going to, you know, constantly know what Blake is doing and what the rest of us are doing by joining us and, you know, being part of the community and in the chat room. But, you know, I'm going to give you a hint. Don't do that today. Because due to increased interest in what we do because of the market environment, we've decided we never give offers during, you know, such a period. But you understand that, you know, the extreme volatility has completely changed the dynamic. So we're going to be starting an offer tomorrow, and I think that's going to be a good opportunity to take advantage of that. So, you know, I'm not going to give you more details. You're going to find out tomorrow. Okay. So if you want to be part of ForexAnalytix, wait for one more day. Trump administration stimulus proposal would seek about 50 billion to help the airline industry. I've retweeted that. Coach, am I bleeding through an interview? Do we have somebody
no,
here?
Michelle. Waiting? Yeah, Michelle Schneider's supposed to be here. I just tweeted her. She's not here yet. She's
okay.
Very reliable. She'll be here.
Okay. So personally, I think that this charade should stop. I think that they should let some of the airline companies default. And the reason I'm saying that is the following. It's not that I don't acknowledge the fact that having to do with specific industries, we have very special circumstances that might happen once per generation. But you know something? There are many companies, Boeing is a great example. You know that Boeing spent 96% of its free cash flow during the past decade buying back its stock at ridiculous valuations. And now Boeing is actually seeking a bailout from the government. Why the hell should taxpayer be on the hook to bail out Boeing and any Boeings on the planet, because there are many examples, when they had so much cash in hand? And what they decided to do with that is spike up their stock price by buying up their own stock at stupid prices so they can celebrate and give bigger bonuses to themselves.
Yeah.
So
you know, actually, some people have corporations actually have gone to the debt markets to do the same. So this financial
the vast majority of them,
yeah,
the vast majority of them was taking on debt
to buy their own
stocks.
stock.
Can you believe that?
Yeah, so they went on margin and they want
us. This is financial stupidity. Yeah. They were borrowing in the market with the excuse that it was very cheap to borrow to buy back their own stock. I mean, this is absurd. I'm against many regulations, but if there should be one regulation in place, in my opinion, should be the following. A, you should ban the ability of any company to buy back their stock by using debt. So you want to buy back your stock, you have money on the side, you will only be able to do that by, you know, using the cash you have on the side and not by going into the debt markets. And B, if you want to take the risk of buying back your stock instead of putting, like, you know,
I see you, Michelle.
an emergency fund or whatever, if you need help in the future, you know, you will receive as much less help as what you bought back in the market. Because you know something, it's not my fault if you want to be buying high and not sell cheap. They should be punished by having to sell cheap. So let them go back in the market and sell back the stock they bought back by, yeah, of course, by, you know, going deep
Go
in
to
the
the
red
market.
and
Yeah.
deep in the red and selling with a big loss. But that's their problem. They should have thought better.
Yeah. I'm not in favor of bailing them out either. No one bailed me out when I had margin calls. Anyway, so Mish is here. No one bailed you out either, Steve, when you made mistakes, did they?
Absolutely.
All right, so I think they should take it on the chin too.
Rob also makes a good comment about it. Warren Buffett owns a big chunk of US airlines. Why not let him bail out the airlines? He has 120 billion on the side. I'm adding that.
Yeah.
Time to stop rescuing these so-called expert billionaires. I agree 1,000%. I agree 1,000%.
Okay, bro. Hi,
Okay,
Mish.
enjoy the interview.
I'm sorry I was looking for you under Michelle instead of Mish, so I'm really looking forward to your take on what's going on here. So I'm getting you set up now, Michelle, and I'm unmuting you.
Great. Can you
Yes.
hear me?
Yeah, welcome back, Michelle. So you've done this drill before to share your screen. It's a little green box on your...
Yeah, I see share screen and I want to do this screen, right? You see a 4-chart screen with...
Not yet.
Oh, no wonder, because I have to
You have
push
to
share.
click it. Yeah, there you go.
There you go. Can you see it now?
We got you, Michelle. So,
oh, excellent.
wow, you know, you and I are market veterans.
Yes.
I've never traded a pandemic before.
Well, yeah, I guess if you want to use pandemic as a metaphor, we've all been around for that. But yeah, an actual real one, no. And, you know, Keith and I have been watching Containment, the series, a little bit on Netflix. And yet, you know, this is anything but containment. We haven't been able to contain anything, volatility, price levels, etc. So
art imitating life again.
Absolutely. And by the way, Erin go bra. It's funny, in a happier time, there would be tons of happy St. Patty's Day messages, and I haven't seen one. I just wanted to make sure I did a shout out there.
All right. Well, also there's, besides St. Patty's Day being missing, so is the color green on our screens. So, you know, interesting. I'm wondering what you think here, specifically, you know, that commodities, precious metals also took it on the chin during this. So why don't you just go ahead and tell us what you're thinking here. And it's probably okay not to do anything in this environment, but what are your ideas in this historic time period we're trading in?
Okay, well, I mean, we can cover there's 3 different areas here. So, and I call sort of the trifecta of junk. And one, of course, is the virus itself and the impact that's had. 2 is what's happening with the oil market and the Saudis and the Russians having a bit of a price war here.
Right.
And then 3 is the central banks and the Federal Reserve role of this insane amount of liquidity that they're adding here to try to stop the bleed. Of course, what they're trying to stop is the bleed of the market, and you know, we're still waiting for the stimulus, as other countries are already doing, for people who are actually suffering through losing jobs, not being able to go to work, businesses, etc. So
yeah, the fiscal magic bullet.
Right. So, you know, this is really another classic case where it almost seemed like we were lined up, Main Street, Wall Street. Now we're kind of back into that separation of Main Street, Wall Street. So we're going to focus on Wall Street here. But Main Street does come home to roost, and that's where the pandemic really became evident, is that, you know, you can only manipulate markets so much. So here we are back into mega manipulation, and the thing is we have to lose the judgment because we're in the business to make money. And so a couple of things about SPY that are really interesting, and this is far from saying we bottom, but we certainly could see a bounce. It would not surprise me, given how robust all of the liquidity has been in terms of injecting into the market. From a technical standpoint, even if I didn't know that, we're looking at the SPY chart here. On each time frame, which would be the daily, the weekly, and the monthly, there are reasons for support. I'm looking right here up at the weekly chart. Here is your 2018 low right here at 233.76. Yesterday's low was just a little bit above that at 230. Ooh, I can't even read it. That red is very hard to read. But anyway, it was about 235 yesterday, the low.
Okay.
So there you have it holding the low of the crash in December 2018. By the way, besides this and Qs, nothing else has, but it's important because SPY, of course, the 500, Fortune 500 companies, and these are the corporations that typically would buy back their stock. Number two, here, and I just noticed this morning when I was preparing to talk to you, this is a classic inverted hammer doji. And for those of you who don't know what that is, it's when it gets forced down to new lows and the opening and the closing prices are either virtually the same or close to the same. And very often that means the selling is starting to exhaust. I mean, considering how we've gone down 3,000 just yesterday and then the debacle that we had last week, you know, it doesn't take a genius to figure out that maybe we have some exhaustion on the sell side temporarily. So what I would be looking for right now is, and you can see the bid here is 245.64, so we're already not gapping up, but we are certainly coming in higher than where we closed. And on the SPY, we closed at around these prices are not, it's very hard to see these screens with this red. Why do they do that? But it was about 237, 239.
Yeah.
Okay, so we're going to come in at 245. So what does that mean? If, and I'm going to blow this up. Oh, wait, there's one more. Let me just leave that for 1 second and bring your attention up here to the monthly chart.
What's that moving average? The
this is, okay, so this is the 80-month moving average.
Oh, that's right. I remember you used that.
Yes, yeah. I love this. I actually credit the Aiden sisters for.
Oh, gosh.
Yeah, remember them?
Past. Yeah.
Right. Well, they introduced us to the concept of the 80-month moving average. So 80 months, you know, you've got about 5-6 years worth of data. So basically what that is almost a full business cycle. So again, SPY has held it almost to the tick, as you can see with its drop yesterday. So that's why I'm anticipating this type of bounce right now, but it really wouldn't look so healthy to me, and let me blow this up a little bit, until we get a close above this 260 level right here. That's what I'd like to see. Here's 260 right here. It would clear the move from a couple of days ago, Thursday. Here was, you know, the big covering that everybody got excited about on Friday. Right. So really you're talking about anywhere between 260, 270. And then, you know, we have to start thinking, okay, this maybe is more than just a technical bounce, maybe a better bounce. And what would be great, and this is why people ask me about phases all the time, is we're not in a bearish phase in the SPY because the 50 is still above the 200.
You need a cross.
You need a cross, exactly. It's happened in some instruments, but not in this one. And I'm going to focus on this one because obviously this is, you know, the biggest stocks.
The benchmark, yeah.
Yeah, so here we go. If this actually can get just a meager bounce and chop around for a while and kind of reduce in volatility, wouldn't that be nice? Then we might be able to give that time for the moving averages not only to move closer together, but for the price to get closer for a better risk short. That's possible. It's also possible that we get a much bigger bounce and we actually take out the moving averages and then have a fake out. But this is only, when I say a fake out, I don't think this market is running to new highs or anything. I'm just saying that it might capture in a lot of longs. People are very used to being long. Anybody who's been trading for the last 11 years, and then they get screwed because the selling comes back in. Either one of those scenarios, but what it doesn't seem to me today, although anything is possible, is that we're going to go lower, at least from breaking yesterday's low, at least for now. Now, that's just one instrument. You know what I love to watch? My granddaddy.
Yeah.
This is the small caps.
Yeah.
Very different picture. And this was the picture that started us and our models. Our alpha rotation models got out of SPY and Qs while they were making highs and got into bonds at that time. And the reason why was because using the metrics, we use very much a lot of the modern family here, you know, the Russells,
Right.
the retail, etc. And this was telling a very different picture. This couldn't even get to 2018 highs, let alone make new highs in 2020. So now I had to go back. We well broke below the 2018 low. So I had to go back to 2016, and actually right here, this 2016 low was at 114. We broke through that. So I had to go back even further to find something analogous to where we are. And here, actually, the 2016 low was made in April, I believe. Wait, hold on, maybe that's, no, the 2016 low, I'm sorry, was made here in February of 2016 at 93.64. So we haven't quite gotten there, but we've certainly blown through everything else. So what does IWM have to do? It's going to have to convince us that it's excited about all this injection of liquidity as the S&P 500. And there's a really big fundamental reason why. This is the 2,000 small cap manufacturing supply side stocks within the United States. This is the true measure of how happy the economy is going to be going forward or not. So a bounce in SPY and a bounce in Qs is expected. They have been the ones that have enjoyed corporate buybacks, and they're the ones who are really enjoying any kind of liquidity, zero rates, etc.
Financial engineering really didn't take place in the Russell stocks. They didn't play the same game with going to corporate debt markets and then buying back their stocks, or just using all their cash.
They can't afford to. I mean, these companies, I mean, and this is the thing, is that these companies, a lot of these small cap companies are really struggling and could wind up in bankruptcy. With the liquidity that's coming in and the 50 billion going towards airlines, it still doesn't really hit the manufacturing sector of this economy that we need.
It's a great point, Michelle.
And so I would say, you know, if you want to have some fun trading from the long side for a possible technical bounce, go ahead. But don't get married to the idea of a bullish position or a bullish stance. First of all, you've had, you know, massacre here, but
Yes.
you know, until this really shows us some kind of real strong volume buying that sustains for more than a day and a half. And that's really kind of what I'm watching for. And that would at least start with getting over last week's low, which was at 110. Basically, let's call it 110.
Okay.
If we can get a close above 110, if it's not today, if it's not tomorrow, yeah, maybe we can go back up to 125. Now look what's happening here with the moving averages. We showed you the SPY 50 and 200 still far apart. This is coming closer together. Now this would not be a sellable type of bear phase death cross, because look how far the price is. Your risk is just insane. But it would be really nice to see some kind of bounce and a better risk for a short. And so I really, and by the way, everybody's saying that the market's going to turn completely around if they find some kind of a cure or if the virus starts going away. There's still major inherent problems in this, and that's, people are forgetting about the oil. They're forgetting about the fact that the modern family and the Russells and retail and transportation and regional banks have not participated in this whole rally for a very long time.
Therefore, Michelle, it wasn't really all about the coronavirus. that these things were setting up like the repo market last fall with having problems with the Fed funds market. And maybe the corona was just the match that lit the fuse. And, you know, a lot of people, it's serious to be exposed and infected by the coronavirus, but what's important is what it has exposed rather than being exposed. It's exposed, the emperor has no clothes.
Excellently well said, Dale. Yeah, exactly what I would say in the exact same way. So now let's, oh, I'm so sorry. Hey, Raul, I hear you. Yes, Raul is, I didn't feed the, you know what, I usually feed the dogs at 7 o'clock, and I didn't feed them because I wanted to get in.
Yeah, I thought he was mad because I interrupted you, but go ahead.
No, he's mad because I'm not paying attention to him.
Okay.
All right, if you want to see something really sobering as well as what we just saw, so we saw the supply side,
yeah,
which is the Russells. Here is the demand side. This is the transportation. And of course, look what's happening here. This is, well, we don't know, it's a bid offer, it's, you know, and it's a very thin instrument, which is incredible to me how thin this is. But a couple of things to notice. Broke the business cycle. That is broken. Okay, that doesn't mean we can't rally, but it's broken. Yeah. Closed on the lows. This too, well below the 2018 low. Made a new low on the close yesterday, and in a bearish phase.
Never made a new high.
Oh, never.
Yeah,
even in this little
weakness. Yeah.
Yeah. So now, what is interesting with making a new low yesterday, if we saw a reversal, so what is a reversal? Would mean that we'd have to have great volume and a close over yesterday's high at 138.91. Okay, so that's another thing to look in mind. If you really want to make a case for a sustained bounce over than a day or two, then you must look at the Russells. As I showed you, 110 is really what you're going to look at, and you must look at the transportation. Very important that it closes, let's say, roll, stop.
It's okay, just go ahead.
139 or better. Okay, so that's another one. Last one of the modern family, well, actually not the last one. This is retail. Now, what's really, really sad about retail is forget about 2018 low, forget about 2016 low. I had to go all the way back to 2012 to see the lows that we have seen in the retail space. This is massacre right here. So again, all of these things have to be watched. So I can't say it enough. That doesn't mean I'm saying don't buy and have a little fun on the bounce, but don't get into this idea of complacency from the bull side and think about any kind of bounce other than short term as a bigger sell opportunity. And finally, the instrument in my modern family regional banks that's really been hit by the whole oil thing is because they finance a lot of the oil and gas companies is the regional banks, KRE.
Yeah. And
that too broke through a lot of stuff. Here's your 80 monthly. However, it did hold the 2016, or it's right around that 2016 low of 32.63. We're coming in higher there. So keep that number, 32.63 in mind. And again, if we're going to get any kind of reversal here, we have to start out with a close above yesterday's high at 34.50.
Okay, so the message being, look for some of the weak stuff to give you a positive signal, but your better long most likely is going to be in things like S&P because the break hasn't been as deep as some of these other massacred indexes.
Right, and here's the cues, which the SPY you saw landed right on the 80-month. This didn't even get close to that.
Yeah, I noticed that.
Yeah, another not quite perfect inverted hammer doji, but again, not a bad one. So we would be looking for a close somewhere over 180 to show that this really is going to have any kind of legs.
Okay.
Now,
so,
you want to go to commodities?
Yeah, the ancillary markets now.
Okay, well, let's look at the bonds. So the bonds right now, actually, I think all things considered, with the little bounce here, the bonds are holding up pretty well. We caught the bounce in the bonds from really here all the way up into here, and we got out under 170 because it was, you know, a real topping type of pattern, and we haven't gotten back in yet. And when I say we, I'm talking about our quant model. And I like to use the quant model because it's based on all of the knowledge that Keith, Jeff, and I have accumulated, and James, over a combined 120 years. It uses that type of knowledge and the things that we look at, but it doesn't have the human emotion factor, obviously. And that's why it's done unbelievably well and has so outperformed the market. So right now we're out, but if we get another signal to come in, I think that would be a bad sign. So right now, the fact that we're out, that particular model, alpha rotations in cash, it'll be interesting to see what comes first. Entering any of the indices, because it's either in indices, SPY and Q, cash, or bonds, right?
Yeah.
So right now it's in cash. So that's telling. Okay. So that's number one. We want to keep an eye on that. We also want to keep an eye on what's happening with the dollar, which all of a sudden, with all the money that's being printed, it's become almost a flight to safety situation. And look how strong the dollar is right now, which was something that I was completely wrong about. I will admit that. I thought the euro, it closed great. It closed above both moving averages, was ready to explode while the dollar would collapse. And just the opposite is happening here. This is actually going to come in right around 104, 103.80, 104. So the dollar is the reason why you're not getting any sustained rally in the gold, although it's holding the 50-week moving average. The silver got absolutely crunched. Look at that, pathetic. And that's actually even lower still. And then the miners, which tried to get some kind of really big move yesterday, might have a little bit of digestion. So again, I'm not saying I would not look at gold and miners. I would still look at them for a clue, because I still think, and I haven't seen anything that changed my mind yet, the Fed is fighting desperately against deflation. And of course, with oil, that's been a situation, and all the food prices low. But we've had issues now with this incredible amount of QE, with the rates at zero, with any kind of drop in the dollar, and the economy really basically going to a screeching halt. That stagflation possibility is still with me. And so I would look at the miners, because miners will tend to outperform before gold if the gold is going to get bullish. Yesterday, I put out on Twitter a day trade in gold, and I just made it a day trade. I got out at the end of the day. We bought it at 137. We got out at 140, and then 140, 150, and that was it. We called it a day. This is coming in lower now, but it's still in a strong trend. And if food, which is in a supply chain disruption in China and could happen here, and now we've got borders crossed with clothes in Canada, etc., and Mexico, where we get a lot of our food, I would also watch the DBA, which is the agricultural fund for all of the wheat, corn, soybeans, etc. And if this can get a close of 1405 or better, and I mean a close, and even ideally a weekly close, because I'm showing you right now the weekly chart, then you have a nice little risk underneath the low here at 1350 to see if the dollar starts to come off and food supplies start to really wane, and considering how much food has been bought by people throughout the world and in this country, then that could be interesting as well.
How far back do you have to go on DBA? I know it's probably only been around for about 5-10 years, but are these new lows for a long time?
Yeah, let me take a look here. Well, let's get the monthly chart that's going to give us the most amount of information.
Okay, yeah.
DBA looks like it started. Yeah, it started in like 07.
Okay,
so
these are new lows.
These are new lows. Absolutely. These are new lows. Right. So, you know, this is where the deflation is coming out. But the Fed and the central banks are doing everything in their power to try to stop that. So that's, you know, a positive on the one hand. And on the other hand, I'm waiting. It hasn't happened yet, but I still think that this could backfire, or the old be careful what you wish for. and turn out to be more of a stagflationary situation, which the liquidity that they added we haven't seen since the mid-70s, and guess what? Mid-70s is when we went into stagflation.
Yeah, so let me ask you this though, Michelle. Monetary policy has a very long lag time, and we may be seeing the tail end of QT, and that may be part of the reason for the impact of falling markets. And maybe it takes 6 months or so for everything the Fed is doing now to start to have some impact.
Oh, it's very possible.
I mean, what do you think lag time is on Fed policy? People have different opinions.
Well, just let's go in history here. 2008, when they first did the injection in 2008, the market did not bottom until the spring of 2009.
Okay, right, a year.
Almost a year. It was a little less than a year. So, it was like 8 months. So 6 to 8 months. And that was in a situation, though, that was very different because we were talking about a mortgage debacle that mainly was in the United States. And the Fed had a lot of tools at that point because the rates were in zero.
Great point.
This is a very different scenario right now because this is now not just affecting the United States. I mean, there was some global fallout, obviously, during 2008, but this is the whole world with the economy shut down, with the Philippines closing down their market. I mean, this impact really is not going to be a question of how long is it going to take for all this injection to, for all this injection to come into the market, but really to me it's going to be more of a case of what happens if this doesn't help.
Yeah, Fed, less tools, hope for a vaccine. I mean, I've read articles that because of the mutation of the virus, it's going to be a very difficult endeavor to get a vaccine. What are you and Keith and your family doing? If you want to talk about other markets, that's fine, but what are you doing personally during this crisis? Not social distancing, but physical distancing. And are you and Keith like Rob and Laura Petrie in the Dick Van Dyke Show, sleeping in separate beds?
No, we're more like, the Titanic. We want to go down together in the ship.
All right, look, I didn't plan to say that. I just can't help myself. But are you doing anything special? Are you staying indoors or?
Well, yeah. I mean, we both love going to the gym, so we haven't been going to the gym, which is driving me insane. So because I love, but and also we're not eating out in restaurants. But Santa Fe is a little bit different than the rest of the country. It's actually a really good place to be right now because of the fact that we have a dry climate. So we've had 21 cases as of yesterday in New Mexico.
Mainly Albuquerque.
Right, and the shelves weren't Bernalillo in Albuquerque, and the shelves have not been picked clean. I went to Trader Joe's on Sunday, and there was no pasta, no beans, no that kind of stuff. But there was tons of produce and goods. So we're feeling almost like in a little bit of bubble here. So we're just being careful. No restaurants, no gym. We haven't gone out to socialize. I haven't done things like go get my nails done.
Are you getting any kind of very big macro message? Are you worried about this? That perhaps because the Fed is out of tools, that maybe we could get at least maybe another year or two hurrah out of this. But we're fortunate. We could make a living being inside at our workstation and trading. What do you think the longer term implications are for
in terms of mega trends? No, I think this definitely is going to have some. Well, there's two things. Humans have very short memories, so there's that. But there's also the idea there will be some permanent changes, and I think people who can work more remotely will. And I think that's going to be the biggest impact. Is that people? But I do think that we're social animals, and once this passes, everything will go back pretty much to normal, except for maybe a lot of businesses that may really suffer and go out of business here. Remember, most people a year ago when the economy was booming, couldn't put $400 together in an emergency. What's going to happen now? So, you know, it's going to be interesting. Again, what's going to happen? How far is the Main Street impact in these small businesses and these manufacturing companies going to have a long-term impact, regardless of whether the banks buy back their own stocks, which they said they weren't going to do, but all these other banks were allowed to finally borrow money from the Fed. So it's really, I don't know exactly yet, but I wanted to show you one last chart before we say bye-bye.
Okay.
Because this is really important chart
junk
right
bonds?
Here. This is not junk. These are high yield. This is high grade investment bonds. This represents the biggest companies, okay, right here. Intel, General Electric. I have a list in one of my recent blogs of the stocks. So last week, before we saw what was just happening recently, and the, you know, the fact that they're looking for another, what is it, 850 billion in stimulus, et cetera, et cetera. Last week, the Fed gave money to the banks to buy this instrument right here, to buy high grade debt, okay? And with that, that's why you saw this big move and then the close strong on Friday. That was that first announcement of that they were doing that. And yet it took me a while to dig down to see it wasn't the Fed themselves buying, but they were giving the money to the banks to buy. So here we are, the top companies with the highest grade yields. If this cannot move, and look, it's down on the day, you have a 200-week moving average right here. If we can't hold it, get back over the 200-week, and here, we've been below the 80-month before, but now we're sitting right on the 80-month. And of course, so far, we're just having an inside day. I would say if you really want to see what the corporation's appetite and banks' appetite is for risk and whether or not the injection of liquidity does anything for them, it's really that simple. You can just look right here.
LQD. What a great presentation.
Oh, thank you, Dale.
Thank you so much, Michelle. I mean, it's great to have someone that has lived through different cycles give their perspective. And, you know, I'm getting pretty much a takeaway. Be prepared for a bounce. Don't think the bounce is going to carry us to new highs. And this last chart is really key because if investment grade debt is getting downgraded and ends up being junk, we really have problems.
We really have problems, yeah. And
credit markets are really something to watch during this whole scenario.
This is a credit crisis. I mean, this is really, let's just call it what it is. It's a credit crisis. And whether or not that can be abated with the injection of liquidity remains to be seen. Now, the last thing I would say is I was on the floor. Well, I was on the floor for many years, but I was on the floor on October 19th, 1987, which kind of was very similar. I mean, we had the huge crash like we saw yesterday. Rates, of course, were much higher at that particular point, which was part of the problem. Nothing like what we're seeing now. But it took about a year for the market to come back. So in that time frame, you know, we talked about maybe 8 months like we saw in 2008. But if we go back in time, it took even longer at that point. So we'll see. We'll see.
Market had a car wreck and now it's in shock and then has to heal.
Yes, exactly. And right now this this LQD is going actually south, and that concerns me. So those of you listening who are thinking, oh, this is a great buy opportunity, be careful.
Okay, Michelle, why don't you show your website so people could follow you or work with you?
Oh, absolutely. Let me go to Market Gauge here and put that up for you guys. Yeah, we've been really doing great. I mean, like for example, our NASDAQ model is long Regeneron. You know, we were long the bonds in our alpha rotation model. We're short a couple of instruments and took some profits yesterday in another one of our models. So our quant models are doing great. Here's our website, marketgauge.com. You know, I write my daily blog here. Keith does a weekly one. These are all free. And then, you know, we have a lot of different information all around if you want to take a look at our products and services. And then I do education and discretionary trading model as well, which, you know, we did very well in the bonds, and now we're basically almost 99% in cash, waiting to see if it's time to go short again or looking for some kind of buy opportunity if that pans out.
Okay, well, you could follow Michelle at Market Minute on Twitter, and her website is marketgauge.com. She's a pro, and as you could tell, she's been here a few times, and some great ideas. Thank you for edifying the FACE community in the middle of all this turmoil, Michelle. Thank you.
Thank you, Dale. Thank you for constantly inviting me back. I really appreciate it.
All right.
By the way, Granddad Russell is now red. Just mentioning.
All right.
Okay.
Okay. Thank you, Michelle.
Good luck, everybody.
Yeah, everyone, good luck. Getting the pop in Kiwi and Aussie on the Turnaround Tuesday trade. And good luck, everybody. Remember, don't just count your pips, count your blessings. And we'll see everyone tomorrow. Thanks again, Michelle.
All right. You take care, Dale.
Bye-bye.
Bye.